and I think we are now able to begin today's webinar looking at the outlook for the global economy and air passenger flows. So can I start by welcoming you all and thank you for joining us on today's webinar. This is being run as a joint presentation in keeping with the joint forecasting service between Tourism Economics, which is an Oxford economics company, and also IATA. And what we would like to run through today is an outlook for the global economic, tourism, and air passenger flow outlook over the coming years. This is consistent with the report and forecast database that we worked on together last year for the first time as a joint venture between both IATA and Tourism Economics, relying on our Oxford economic forecasts of the global economy. And we are just completing the update, the first update of this service, including the global report, the country reports, and also the online database and web tool. Before we really get into the Outlook presentation, I'd like to mention some housekeeping points. We will be providing the presentation, as mentioned, which will be followed by Q&A. So if you'd like to ask any questions, then you should be able to find a drop-down box at the top of the screen, and you can use the chat icon that's found there to send a message either to myself, David Goodger, or to James Mills, the host of this meeting, or to either of the other presenters who will be coming up. That includes Adam Sachs, who is the president of Tourism Economics, and also David Oxley, who is going to speak specifically to the air passenger forecast from IATA. So feel free to ask questions at any point throughout the presentation, and we will address them towards the end. So to step into the outlook, we'll begin with some of the big picture items that are going to be running throughout this presentation, some of the key themes. So what we're looking at coming into 2015 in terms of an economic outlook is that we're seeing a year of subpar growth, that we're seeing GDP growth for the world slower than it's the average that we've seen over the past 34 years, over 1980 to 2014. And a key part of this is some slower growth from the emerging markets. It's one of the weakest growth years since 2001. And within the total, we're seeing a lot of risk factors and competing trends pulling in different directions. Within the US, for example, we're seeing a slow start to the year, but ultimately a strong economy and some very strong fundamental underlying factors. Within the Eurozone, there's some positive trends. Growth is coming on the mend thanks to the ECB, but significant risks there. Then on the downside, we see Russia is experiencing very deep recession. Japan in recession also, attempting to emerge from that one. And also a lot of risks surrounding the emerging markets, where we just see that sluggish growth that we've mentioned. But central to everything, we do see there's some movements in prices. And this is coming from two key factors. Firstly, oil prices having a huge impact on the outlook over the near term and even into the medium term. We saw incredibly large and sharp falls in late 2014, 50% falls in oil prices over a relatively short period. There has been some rally in prices, but they're still very much lower than they have been in recent years. And we do expect to see some pickup in oil prices as the marginal cost curve suggests that the costs needed for extraction to meet the oil demand over the coming years will rise, and as we see some of the supply overhang easing. And by 2020, we expect the oil prices to edge up to around $85 a barrel, but this is still a real boost to the world economy with these lower prices than we've seen over recent years. And there are also significant risks surrounding that, and notably an upside risk from lower oil prices. And the second key price effect to call out from the start is the exchange rate impacts, where we have seen real strengthening in the US dollar over the recent periods, and we expect this to continue throughout 2015 as we're seeing the Fed starting to tighten, great expectations on the Fed to tighten, while we're seeing further monetary loosening, notably in the ECB and also in Japan. And we expect to see the euro-dollar rate hitting parity by Q3. This has huge implications worldwide for the economies and also for air passenger demand, but we'll begin by taking a more detailed look at some of these impacts within the US. And at this point, I'd like to pass over to Adam Sachs.
Thank you, Dave. I think in the U.S. we're seeing a number of factors that are competing as well. But what's interesting is if you look at the news as it's come out in recent months, most of the economic data releases have been surprises on the downside. And this is an index that Citigroup maintains, which compares what the data releases were in actuality compared to what the consensus of expectations was. And you see, if you follow that red line, throughout most of 2014, the surprises were on the upside in the U.S. That is, things turned out better than generally expected. But things have turned markedly in the other direction in 2015. Retail sales falling in February, consumer spending down, industrial production up marginally, similar underperformance relative to expectations for durable goods and housing starts. And so that does give us some perspective of the headwinds and a bit of loss of momentum in the U.S. economy. And you see that in the Q1 results of GDP increasing in the range of 1.3%. But you can see that our expectations for the second quarter are significantly greater. Why is that? Well, the first is clearly what we see in the labor market, and the chart on the left shows unemployment claims continuing their downward trend, very encouraging, and now on the lower end of what would be considered a strong economy. And so very, very encouraging, and of course the unemployment rate at a high level has come down as well. And so what you're seeing here is more and more workers are going back to work, and so that's increasing the labor participation rate, which is of course holding the unemployment rate steady even as job increases are continuing. But the net effect of that is that wages have been growing. And Dave mentioned the importance of oil, and you see it here in this chart because it's not only are you getting gains in employment, but on a real wage basis, because lower oil prices are essentially driving down inflation, you're seeing increases in real wages being accentuated by those lower prices. And if you see the effect really at the retail level, where gasoline prices coming down to in the range of $2.50 a gallon. If you want to put that into context, what that means is that the average U.S. household is saving about $1,000 a year relative to what the prices were last year. And so that just shows up as disposable income and certainly fuels the outlook for consumer spending. In addition, U.S. households are in a relatively strong place in terms of net wealth. Certainly financial wealth has gained significantly as the stock market has continued to hold its own, but even non-financial assets with the recovery housing prices and other assets has recovered to pre-Great Recession levels. And of course, all this has U.S. consumers feeling quite good, and so both the levels of consumer confidence and consumer sentiment where we were in the mid-2000s. And that's primarily why we now have consumer spending, our forecast for all of 2015, showing growth in the range of 3%, while inflation is quite low. And it's not just consumers. If you look at businesses, capital expenditure expectations are still relatively strong, although slowing somewhat. Our Oxford Economics Capital Investment Leading Index, the red line on the left, showing continued expansion. And then actual non-residential fixed investments. That's what companies are spending on investment, also continuing to show growth momentum. And then on the right side, you see the Purchasing Managers Indices showing that both in manufacturing and in services, above that 50 parity line, showing expansion in terms of purchases. And it's a good leading indicator of the economy because it's what companies are purchasing as inputs into production in the future. But this brings us to the big picture for the U.S., which is that we expect growth of nearly 2.7% over not only this year, but over the coming 2 years. And that is somewhat of a downgrade from where we were at the beginning of the year, where we expected growth somewhat above or in the range of 3%. And it's largely a function of what we see happening outside the U.S. that is affecting that downgrade and the outlook for the U.S. The implications of that on travel. Well, outbound from the U.S. is actually going to perform well this year. You know, the strong dollar, as well as the relatively strong position of households and businesses, should drive growth and departures this year in the range of 6%. And moving forward, long-haul travel, we expect that will be outside of the Americas region to destinations further abroad. We expect to grow faster, partly due to the development of those destinations that's going to drive demand out of the U.S. But if you think about that in reverse, inbound to the U.S., we expect to slow significantly as we get through the year, particularly in the peak summer months. You know, when you're looking at euro-dollar depreciation of more than 20%, yen depreciation in the same range, significant depreciation of the real. What that's doing is not only making travel to the U.S. much more expensive, but it's also making other places relatively cheaper. So even, say travel out of Asian markets where the currencies may be more stable relative to the dollar, well, other places are going to be significantly less expensive and more attractive, such as Europe. And so we expect U.S. inbound travel to grow very modestly in low single digit this year. And so that'll pass it back to you, Dave, to talk about Europe.
Okay, thank you, Adam, for the run-through of the U.S. outlook. Back over here in Europe, this side of the Atlantic, things are not looking quite as positive, particularly if we look with some of the historical data. We can see that the Eurozone growth rate, it has improved over the past year. There has been growth, but it has still lagged the U.S. and also the UK significantly. But there are good reasons for this, and there are also some very good signs of improvement, as well as some key risks. One key reason why we have seen this slower growth is that while the US and the Fed has been continuing to push ahead with its quantitative easing program, with that huge monetary easing, what we've seen in the Eurozone is that the European Central Bank has been shrinking its balance sheet. And this is effectively the opposite of the quantitative easing. This is a monetary tightening. So this the shrinking of the balance sheet from the years 2012 through to 2014 has been part of the reason for that slower growth, coinciding with the timing of the slowdown in some of these external growth, such as some of the Chinese demand growth for exports. This is being recognized, and what we're now seeing going into 2015 and into 2016 is this massive monetary easing, this huge increase in the balance sheet, the quantitative easing, at the same time as we're seeing those programs finishing in the US and also in the UK. And this is one of the key reasons why we now see the exchange rate weakening. And this is going to have a massive impact on the relative performance in the euro, as we've seen that Eurozone exports have been somewhat subdued due to this stronger currency. As the currency is weakening, we expect there to be some very good benefits in terms of the net trade balance. And there will be some benefits to some limits placed on the deflation expectations also from this euro movement. So we shouldn't expect to see huge deflation, which is one of the worries. It will limit some of the expectations of deflation, which is some of the bad effects of deflation, where people can expect prices to continue to fall as wages fall and people defer their purchases. What we're actually going to see is negative inflation. Technically, it's deflation, maybe termed as disinflation, but it looks like it's largely going to be characterized as some goods deflation, that it's coming from the lower energy prices, pulling down the overall prices, and as long as the expectations are for this only be a short run, as is looking likely to be the case, this will then have a positive effect, as in the US, on the disposable incomes. We should see the price levels falling or growing by much less than average wages, seeing household disposable income and therefore household spending rising and accelerating throughout 2015 and into the medium term. At the same time, we also see some easier credit conditions, some greater lending to households, but also beginning some more positive signs for business and in terms of investment. And this is already starting to become evident in the business side, with employment growing across the euro area. And we saw some of the largest improvements in employment within the region in Q2 of last year. And all of this is going to continue to support the household spending and the confidence. And overall, what this then means in terms of the travel demand from the Eurozone is that we expect to see some growth within the Eurozone, growth from the Eurozone. This has been, over the past few years, we have seen some increase in the short-haul share of travel, as there has been some concerns about the direction of the economy and some lower consumer confidence. So we can see that the total departures from Eurozone have been faster than the long haul, as the intra-regional travel has been strong. We do expect some of that to unwind and some increase in the long-haul travel as recovery becomes well entrenched, but there will be a lid on this from some of the exchange rate dynamics that Adam talked about. For example, the travel to the US will be somewhat subdued because it is that much more expensive to travel to the US because of the strength of the dollar. It is also worth noting here that elsewhere in Europe there are positive trends, notably from the UK. There is some very positive economic activity within the UK. The strong growth that we talked about is leading to some acceleration in the travel demand, and notably in some long-haul flows. But so far, so rosy. We do have to acknowledge that there are some very large risk factors out there. There are things that could derail some of this relatively optimistic growth picture. One of which, is receiving quite a few column inches at the moment, is the events taking place within Greece. And the key question is, can the Eurozone weather a Greek storm? The baseline forecast is that we don't necessarily see the Greek storm, and not everything comes to the head, that we do see some negotiated outcome, as has been the case time after time over the past few years, as everything gets pushed to the wire, and then there is some settlement, and everything moves on relatively quietly for another few months or years. But there is still a significant risk of Greek exit that we place at around 25%, and a key flashpoint for this to happen could be in July and August, where there is a very large amount of debt repayment to the ECB, and it is not totally clear that Greece has the funding available to make that payment. But ultimately, there is a choice that needs to be made between levels and growth for Greek economic activity, whether they want to maintain their current level of activity by remaining within the euro, or by defaulting on some of this debt by not undergoing all the necessary reforms, leaving the euro. There will be a large drop-off in activity followed by growth, and the key question they have to answer themselves is whether that growth will be sufficient to regain previous levels. But for the euro as a whole, the key risk is on what we term as the contagion, and so whether there are any risk premia placed on debt and lending to all other countries. As it stands, the exposure to Greece alone is relatively small. Trade exposure is very small. The trade to Greece would only have a minimal impact on GDP, and the bank exposure to Greece is also relatively small. Now there have been moves since 2012, when the exposure was much larger, to protect a lot of the banks. So we see the comparison between the red baseline figures for our outlook and the yellow, which is the Greek exit with no contagion, is that the overall impact on the euro area would be relatively small. The key risk is then whether there is the contagion, whether the risk premia for some of the other peripheral countries rises, and at that point you could see a lot of these other countries pushing towards the area of more unsustainable debt and losses in confidence and activity within those countries, which would come with a much weaker outturn, but overall may not be sufficient to push into recession, given all the other moves taking place from the ECB and the quantitative easing taking place. And finally, while we're looking at Europe, the other key risk factor, and also a reason for some of the slower growth that we're seeing in 2015, is what is happening within Russia. And this is also crucial for what we're seeing in terms of some of the travel trends and air passenger trends for 2015. So looking back to 2014, towards the end of the year, so since we did our first air passenger forecast with IATA, we have seen a huge fall in the oil price, as mentioned, and along with this, we saw a very large depreciation in the price of the ruble, as there were sanctions already in place against Russia, but they were being supported by huge capital inflows from their oil trade. As that oil flows fell away, the capital inflows fell away, the capital outflows became a lot more prominent, and we saw this huge loss of confidence and the tumble in the value of the ruble. And what this means essentially is that we see a very large recession within Russia that was not immediately apparent a year ago, where we saw some slowdown, and it certainly wasn't apparent in October when the sanctions were in place, and we saw a mild recession, and before growing to moderate growth in 2016. We now see very deep recession within 2015 and only a modest recovery likely in 2016, given everything that's happening in terms of the oil price and the value of the ruble and confidence in the Russian economy. And what this means for travel is that we see some very large falls in Russian travel demand. There has been some increase in share in the domestic Russian travel market, but overall the demand is falling very heavily. And it's quite clear that in terms of international travel, this is very strongly linked to the ruble. We saw some falls in travel to some key markets earlier in 2014, partly related to all of the sanctions. Notably, we saw some falls to some of the key European destinations imposing those sanctions, whereas other destinations, such as Turkey, continue to enjoy growth from Russia. But as the ruble fell in late 2014 and the oil price dropped, we then started to see much larger falls for some of the key destinations for Russian travelers, and we notably saw that large drop-off as the year ended and into 2015 in the travel to Turkey, and we would expect to see a very weak Russian travel market for the remainder of this year and likely into 2016. And to then round off the economic overview, I'll hand back to Adam to quickly run through some of the Asian markets, notably Japan and the emerging markets.
Great. Thanks, Dave. Well, just to real briefly touch on Japan. Things do not look particularly bright out of the Japanese market either, and consumer confidence remains negative and is turning down, and recent data such as retail sales show a pretty tepid consumer market overall. And I think the real risk here is a slide back into deflation within Japan. And it's a little bit surprising because we had a consumer tax hike last year, and and there was some expectation that would, and also some very loose monetary policy. Yet CPI inflation you see on the red line now coming back down. Balance sheets of Bank of Japan elevated, and the discount rate almost as low as it can go. So monetary policy is doing all that it can, yet we're still not seeing a lot of traction. The one area that we do see as a bit of a bright spot is on the trade side, and that's very much a function of the stronger dollar, and therefore the weaker yen is making Japanese exporters more competitive, and we're seeing that upturn there for the Japanese economy. And for travel demand, there's, when you kind of put all this together, you get a pretty muted outlook for Japanese outbound travel. See that it was negative in 2014. We expect it to be relatively flat in 2015, even modestly negative, before rebounding in 2016. And if you look over the last 20 years, Japanese outbound has been much stronger regionally than to long-haul destinations. And so the U.S. and Europe have lost share of Japanese outbound. And we expect that to continue through the forecast period. And that has partly to do with demographics and the aging population in Japan as well. So let's move to emerging markets, where I think there's some really important points for us to consider in terms of the effects on global travel and particularly air passenger demand. Recently, the IMF met, and its chief noted that they saw the risks, global economic risks, to be more controlled than they were a few months ago. We disagree with that point and believe in particularly emerging markets, the risks have been accentuated in recent months. And as a result, if you look at our forecast evolution, what we've forecast since March of last year through to our most recent forecast, you can see some stability, but minor downgrades to China and Indonesia and Mexico and South Africa. but significant downgrades for Brazil, where we're now forecasting for this year GDP growth contracting. The same, obviously, for Russia for a variety of reasons. The only market where we have a notable upgrade to our outlook is for India, and I'll talk a little bit about that in a few minutes. One of the reasons for these downgrades, and indeed some of the accentuated risk in the emerging markets, is indeed the strength of the U.S. dollar. It's really a defining component of the outlook right now. If you look throughout history, the relationship between the strength of the dollar, which we've inverted here as the blue line, and emerging GDP growth, you can see that in that 1998-1999 period, as the dollar increased in value, you saw a significant decline in emerging market GDP growth. The same thing in 2001, the same thing in 2008, and now we're seeing really another edition of that here in 2015, with both the downturn in emerging GDP growth and, of course, that coinciding with a very strong U.S. dollar. There are a number of channels that are driving this. One of them is you've got that comes along with weaker commodity prices often, and the emerging markets are producers of commodities to a large extent. It also tends to drive capital flow reductions into these markets, and so it reduces investment. It affects domestic monetary conditions because higher interest rates then are required to stabilize monetary conditions in those markets. It affects balance sheets, and of course debt, a lot of it held in U.S. dollars. The cost of servicing that debt goes up as well. So these are all the channels and why it's so important. If you look at external debt in emerging markets as a share of GDP, the red line is the 18 key emergers, and then the blue line is when we exclude China. You can see that it's come up quite a bit over the last 5 years as a share of GDP. And what that does is it increases the exposure of these markets to an increase of the value of the dollar, and therefore the cost of that debt. I mentioned also commodity prices and why that the value of the dollar makes a difference. If you look at the chart on the left, markets like Korea, Taiwan, China, India, they're all net importers of oil and also non-oil commodities. That means that all other things being equal, a stronger dollar, which is how these commodities are priced, means that these net imports are more expensive to these markets, and so that's why a stronger dollar is, of course, a negative for these markets that are net importers. Now, all of this has been muted by the fall in oil prices, thankfully, but where we see a really a strong impact and also a very big risk in terms of a nonlinear impact of the dollar would be on capital flows. And you can see on the right that as the dollar, the blue line, as the value of the dollar has gone up, that portfolio flows in emerging markets has gone down markedly as well. And that of course, has financial market risks that could much exceed the effects of some of those other channels. And so our overall outlook for emerging markets, as Dave noted in the beginning of this presentation, is for a real a slowdown, particularly in 2015. Note the black line for Latin America and the blue line for Eastern Europe, Middle East and Africa emerging markets, both well below that emerging market average. And even in Asia, you can see that slowdown. But if you want to compare kind of the big picture, emerging markets are still going to be growing faster than the average of the world economy and certainly the G7. So we're not writing off these markets, but I think we need to anticipate a slower period of growth. And one thing to highlight that I think is particularly interesting is that we look at this chart and you see back through 2000, China outpacing India in economic growth. We've got a real, kind of a turning of the guard here in starting in 2016, where we expect India to start outpacing China. A lot of that is demographically driven, the young population versus the aging population of these two markets. But also India has a significant amount of catching up to do in terms of per capita income, a lot of investment gains to be made as well in terms of productivity. Those gains have been, much of those comparatively have been already realized by China. But just keep in mind that even by 2030, per capita income in India will be less than China's per capita income levels are right now. And so the implications on travel are that we do expect India outbound travel to accelerate through the forecast period, but not to get to the point where we saw in China as gains in China, economic gains in China are going to produce more outbound travel than in India. It's simply a larger market and a relatively wealthier market. And so growth trends in terms of travel out of China and within domestic China will still be stronger than India. But I think what we can expect is some acceleration out of India where we see actually a modest deceleration out of China. Dave, pass it back to you.
If we could now pass this over to David Oxley from IATA to take us through the air passenger outlook.
Okay, thank you, Adam, and thank you, Dave. So I'll want to use my portion of the presentation, as I say, to give a brief overview of some of the key trends and stories from our latest update of our long-term air passenger forecasts. So the key points, as shown on this slide here, is, and starting at a very aggregate level, is that the long-term outlook is clearly very positive for global air travel. Taking a step back, increases in living standards, as well as a long-term decline in the real cost of air travel, mean it has never been more affordable for as many people to fly than this is today. And broadly speaking, we think this trend is likely to continue into the long run, which will stimulate further demand for air passenger travel. Indeed, as Adam just mentioned, although emerging market growth is going through a bit of a tough period at present, there remains plenty of potential for catch-up, which will help to propel air passenger demand along in the long term, as well as future expected gains in the advanced economies, of course, which we'll look at a bit later on. But our central forecast is for global passenger journeys to increase by 4% on average each year over the next 20 years. And this translates into 2.2 times the number of passenger journeys in 2034 than we saw last year. So the aggregate picture that I just mentioned, though, of course, masks significant variation at a regional level. So that's what we're showing here on this slide. As we can see, the biggest expected increase, perhaps unsurprisingly, in passenger journeys is expected to be to, from, and within the Asia-Pacific region. We expect passenger journeys to and from and within this region to increase by, on average, 4.9% each year over the next 20 years, which translates into an additional almost 1.8 billion passenger journeys in 2034 than we saw last year. The slowest regional growth, on that slide, was in Europe at 2.6%, although, as I'll mention, I'll come back to later on, this still translates into an increase in passenger journeys of around 600 million, so it's not to be sniffed at. So for me, there's some of the really interesting stories beyond the aggregate and regional level, and it's at the country, the market, and the country pair level where some of the interesting stories really lie. The ongoing emergence of China in this regard is an obvious story for anyone with half an interest in the future of aviation. Despite the weaker growth potential that Adam just mentioned going forward than was perhaps the norm during the 2000s, the fact of the matter is that China really is in the middle income sweet spot that really matters for further gains in air travel demand. This has been boosted over the years by, of course, urbanisation along the eastern seaboard and other factors. But clearly the juggernaut of China has a lot of momentum, and this is a key feature of our forecasts. For me, what really puts the expected growth in China into context is the fact that its domestic air passenger market is expected to add more journeys over the coming 5 years than in the rest of the top 5 domestic markets combined. So that's what this slide here is showing. It's showing that we expect domestic passenger journeys in China to increase by 170 million, or there to be 170 million more domestic passenger journeys within China in 2019 than there was last year. And as you can see, apart from the US, none of the other markets really hold a candle to this increase. Our forecasting model and framework uncovers less obvious, but nonetheless still impressive domestic markets that are going to gain strongly over the coming years too. Notable examples of which are Colombia and Vietnam, both of whose domestic markets we expect to overtake those of France and the UK within the coming 5 years. This slide here shows the ranking of each domestic market within global domestic markets. And as we can see, Colombia cements its position in the top 20 largest domestic markets throughout the forecast horizon. Vietnam's rise is even more impressive. In fact, having been outside the ranks of the top 20 largest domestic markets last year, it's expected to climb above Colombia by 2019. And to prove this wasn't a fluke or a flash in the pan, we expect it to break into the ranks of the top 10 domestic markets in the 2030s. So clearly a lot of potential in some less obvious candidates. The beauty of our bottom-up and very granular forecasting framework also is that it allows us to look at large coming changes at a country pair level too. So there's numerous examples one can zoom in on, but I've looked at the India-United Arab Emirates route here, which is we expect to be a very large gainer and to enter the ranks of the top 10 international markets in the next 5 years. We expect passenger journeys on a bi-directional basis between these two countries to increase by 4.3 million over the coming 5 years. And to just really put this in perspective, this increase is the equivalent to 12 daily return services on fully laden A380s, so a lot of potential there too. But over the long term is where you really see the fundamental shifts in the underpinnings and the main drivers of what we think will drive passenger demand to really rise to the fore. And two broad points stand out. The first is that a combination of challenging demographics and comparatively modest expected future gains in living standards are likely to constrain growth in passenger demand in many developed economies over the coming 20 years, at least in percentage terms. And the former relates to the fact that it is in general people of the working ages, between the ages of 15 and 64, who fly the most often. So if you're seeing countries whose population is aging, that should have a negative impact on the average propensity to fly. This slide I have here shows the example of Japan, which is a notable case of a country facing both a population and a demographic crunch in the near term, which in the near and the long term, of course, which will have a big bearing on the future of its air travel market. So what this slide shows is that three individual population pyramids for Japan, showing how things are expected to stand in 3 separate years, all 10 years apart. So we have 2014, 2024, and 2034. Two things should be very clear. The first of all is that having already peaked in 2010, Japan's total population is projected to decline throughout our 20-year forecast period, from 127 million last year to just over 118 million in 2034. But the other notable feature, which is illustrated by the population pyramid, is that the Japanese population is also going to be significantly older and more top-heavy in 2034 than it is today. And that's represented by the blue bars, which show the population of the age group, the number of people in each age group in the economy over time. We can clearly see a shift towards the top of the y-axis over time. All told, we estimate that the combination of these population and demographic trends will constrain growth in Japanese air travel by around 1 percentage point each year on average between now and 2034. Now that's quite a headwind, and that is a large part of the reason why Japan's air transport market is expected to slide down the ranks of the world's largest, which is shown here on this slide, over the coming 20 years. In fact, as we can see in this chart, Japan's market is expected to fall from number 4 at the minute to number 8 in 2034, being overtaken by India, Brazil and Indonesia in the process. Such dynamics also play out at a country pair level too, which is what this slide shows. So this shows the top 10 international air markets ranked by size over time. And the key one I'd like to draw your attention to is a case of Germany-Spain, which is number 4 at present. But given a combination of sluggish GDP growth, of course, but also dire demographics in both markets, we're expected to slide from number 4 to number 8 over the long run. But being able to isolate the individual key drivers that will shape air travel over time also uncovers some very interesting stories too. This slide shows the constituent parts of long-run passenger growth rates for the India and Chinese air passenger markets, which of course are the 2 most populous countries in the world, and 2 of those countries whose economic futures was compared by Adam earlier on. The key thing I want to draw your attention to in this slide is the starkly different role that population and demographics will play in both of these markets over time. So we're looking at the red bars in both of these cases. So all else equal, the 0.8% on the right-hand side indicates that or stems from India's young and growing population, which all else equal, as I say, is expected to boost air travel demand by 0.8 percentage points on average each year over the coming 20 years. By contrast, though, by virtue partly of its one-child policy, China's ageing population, which is only likely to get worse from this point in, is expected to present a 0.4 percentage point headwind to air passenger growth each year over the long run. So clearly, population and demographics can be very powerful drivers. And an interesting fact here, if India and China shared the same demographic trends over time, we'd actually be picking them to have a similar CAGR over their 20 years. A big difference between the 2 is the demographics. The second broad point, though, I'd like to come back to and make with regard to long-term outlooks for air passenger demand is the important role that the starting points play. So let me illustrate. Even a slow growth rate produces very large increases in passenger numbers in the large markets of today. And nowhere is this more so evident than in the US, which is shown in the second blue bar down on this slide. So what this slide is showing is the expected increase in passenger journeys, total passenger journeys to, from and within each of these countries between now and 2034. And in the boxes to the right-hand side of the chart, it shows the corresponding compound annual growth rate that goes alongside the increase in levels. The key thing for the US is that given its very high starting point, and that it's the largest passenger market in the world at present, it's expected to add more than double the number of passengers than in India by 2034, despite having grown at half of the actual growth rate over the same period. So we can see on the right-hand side there's a 3.2 versus a 6.4. So clearly, while the relative ranks of air travel markets will shift over time, investment in airports and other related infrastructure will remain a highly important issue in even today's most mature aviation markets. It's just taking a step back, is a very uncomfortable truth facing any forecaster in any discipline, that any forecast you're going to make today looking so far out into the future is likely to be proved wrong, unfortunately. And that's not because we're not trying hard enough, but there's simply too many things and a number of future states of the world that can unravel. But to counter this inherent problem for any forecaster, we use scenarios to look at the uncertainty and put some bounds around our central forecast, which is shown on this slide in the green line. So we have run indicative upside and downside scenarios to explore a number, or just two, alternative plausible states of the world. I'll just illustrate how this can change the outlook for air passenger demand over the long run. We've included an upside here, which is the blue line, in which includes a number of different factors, different assumptions than in our central case. Namely, we've assumed that oil prices decline further in the near term than we have built into our central forecasts, which provides a boost to passenger demand in the near term as it feeds through to airfares and stimulates demand. The upside scenario also assumes that air policy liberalisation gathers pace a little bit quicker than we've assumed in our central scenario, which assumes there's no change in current conditions. And we've also dialed in a little bit of a stronger, faster increases in living standards. So the upshot is that in this case, we expect air travel could grow at a multiple of 3.1 between now and 2034. The downside scenario shown in red on this slide is a less rosy outlook, where the near-term outlook is punctuated by the occurrence of one of the number of macroeconomic shocks, as discussed by Dave earlier. This also includes other trends in the long run, such as increased protectionism and a bit of a rowing back in the liberalisation of some air markets around the world. And in such a case, air travel's growth could be limited to just a multiple of 1.8 between now and 2034. But the key point I'd like to finish on, and to just really underline the bright prospects for air travel over the long run that we have in our model, is that even in this low-end scenario, this is generating an additional 2.2 billion passenger journeys annually by 2034, which is a sizable increase. And finally, we've included anybody participating in today's webinar will be able to receive a 10% discount on our products if they go to the web link shown on this slide and enter the promotional code also included on this slide. So please bear that in mind. Cool.
Okay. Thank you. Thank you for that, David, and also thank you to Adam. Just to finish off, we would like to invite any additional questions that anyone may have. I do have one here which I think may be best suited to Adam, which is asking about the expectation for Canadian outbound travel, in particular to the US, as a result of the strong dollar.
Yeah, thanks, Dave. It's a good question. I think we've got a pretty strong opinion about that, because if you look at historically the relationship between the Canadian to US dollar and travel from Canada to the US, they very closely together. And so with the depreciation of the Canadian dollar to, in the range of 80 cents now, we're looking at very, very likely a decline in Canadian travel to the U.S. this year, particularly to border states in the U.S. So the aviation component is not quite as sensitive as the land border crossings, which often involve quite a lot of retail. But nevertheless, it's going to be a difficult year for markets in the U.S. that are depending on Canadian travel.
Okay, thank you. An additional question we have on a similar basis is what would be the net impact of the weaker euro and stronger dollar on the transatlantic travel routes? Do you want to pick that one up again, Adam?
I could give it a start. We did a piece of analysis last month looking at what is if we could isolate just the exchange rate effect, what would it be on transatlantic travel? And it has the elasticity of that indicates that a 10% movement in exchange rate affects a 2% difference in the growth rate of travel. And so what that means is, we've got, let's say we have assume a 20% year-over-year average depreciation of the euro. You'd be looking at a difference in what we would have otherwise forecasted of about 4%. So that would bring us to probably, if we might have forecast around 4%, brings us around flat for 2015. So I think our expectations for Europe to the U.S. would be very modest indeed for this year, and some of the initial bookings data bears that out. The other way around, I think we, by the same token, see strength in in the range of 6 to 7% U.S. outbound to Europe. I mean, there's very positive presentation of the opportunity for value travel to Europe in the press right now in the U.S., and I think that's going to drive travel of particularly leisure European vacation by Americans.
An additional one, which I think maybe if you can speak to this one, David, it's in relation to the China and India drivers' contributions chart specifically. The question is, what was the other category? What's incorporated within that?
Okay, thank you. That's a very good question. That essentially is a catch-all term that captures all the other elements that we built into our modelling that aren't captured elsewhere, of course, being another section, but that captures things sort of change in urbanisation, other factors as well. Some liberalisation elements come into there as well. Yeah, so it's really building in some of the impacts from the long-term decline in the real cost of air travel that we see over time, given that planes generally, every time a new generation of plane comes in, is generally about 20% more efficient than the previous one. So that falls roughly about a 1% decline in the real cost of air travel over time, which would otherwise isn't captured in the living standards and population and demographics section. So a combination of things, but generally the boost from cheaper travel over time.
Okay, thank you for that. We've run through all of the different questions. We've had a couple of duplicates. Obviously, the dollar being a large part of the story, and notably the oil prices, which we have talked to in some detail. So at that point, I think we will finish, and would like to thank everyone for their time today. And if you do have any additional questions, please feel free to contact us afterwards. You can see the contact details for the three of us on the screen right now, or you can get in touch with James or anyone else from our team who have been in contact with you in setting up this webinar. And I would just also like to confirm that the slides that we have shared today will be sent out to everyone on the registration list very shortly. So once again, thank you for your time, and I'd like to wish you a very good rest of your day. Thank you.